It's 2025, and there's a lot of excitement happening with the collar. I know that sounds kind of strange. I never thought I'd be saying that myself. However, with pricing the way it is in some stocks, there's some things that you can do that can be very exciting in terms of a risk to reward that you have not been able to do in years past. Before we get into it, I want you to watch this evergreen video that we did a couple years ago explaining how the collar works. If you already understand how the collar works, go ahead and fast forward at about 5 or 6 minutes till the end, and we'll show an actual collar price today.
Hi, my name is Mike Tusaw. I'm a financial advisor from St. Charles Wealth Management. Today we're going to discuss the collar. Now, the collar is an extension of a married put. We're going to talk about how you can use it today and also how you can have the cost of the put financed by selling a covered call against the same underlying. So it's important to emphasize that the way we're going to present our collar today is kind of an extension of a married put. So if you've not watched our married put video, I'd highly recommend that you watch that first before watching this video. So once again, as we talked about in the married put video, option trading is about shifting risk. When you actually own a stock, you have the downside risk of the stock. When you buy a married put to protect the price of the stock from going down or to protect yourself from the downside of the stock, you're not getting rid of risk. You're getting rid of the downside risk of the stock, but you're simply shifting risk, meaning that you shifted your risk from the downside of the stock to the premium that you paid for that put option. What a collar can do is that can take that risk shifting to another level. The way with which it does that is that it allows you to sell a covered call to actually use the premium of the call that you sold to finance the price of the put. That way you'll end up having protection. However, you won't have to pay for it. Now there's some downsides to it too, and that's what we'll discuss today. Let's start by reviewing our married put risk reward graph. As you can see on this risk reward graph, you have the risk reward of the stock. We're assuming we buy the stock for $20 a share and we buy 100 shares of it, hence the 2,000 mark as the initial cash outlay. But what we're also going to do is we're going to buy a $20 put option to where we pay $150 for this put option. And you can see that as the stock goes higher, we still participate on the upside of the stock minus the $150. If the stock goes lower, we're protected at 20, but the way with which we're set up to shift the risk is that we're paying to be protected from 20 on down to 0, but we paid $150 for that privilege. And that's what this graph shows. So now let's look at the collar itself. Right now we have a different stock than the $20 stock that we had up a moment ago. We now have a $50 stock up. And we've looked at it and we've determined that we want to own the stock. We like the idea of being protected to the downside, but we also feel that the cost of being protected to the downside is a little bit much. So instead of buying an at-the-money put, what we do is we buy the stock and we buy a slightly out-of-the-money put. Stock's at 50, we're going to buy the 45 put. And by buying the 45 put, what that does is that protects us from 45 down to 0. So even if the stock is at 0, we have the right but not the obligation to sell it at 45. That's what gives us our protection. We shift that risk. But in looking at it, we decide, you know what? I just don't think that I want to pay the $1.15 in this instance. So what I'm going to do is I'm going to sell a covered call against the stock for the same price, the same amount out of the money. Now, a lot of times you may get a similar price to what you sell the call for as what you buy the put for when they're equidistant out of the money like this, just as far out of the money on either side. But there are times to where it'll be a debit. There are times to where you will get a credit. In this example, everything is even because of the fact that, well, it's XYZ stock and we want to keep things simple. So what this does, you can see on this drawing that you have the risk reward graph like you did with a put option, to where you have the straight line on the bottom, meaning you can't lose anything past the 45 level. However, the disadvantage is that you can't make anything above the 55 level. So what this does is this collars the stock itself. You are set to where you know that you can't lose more than $5, but you know you can't make more than $5 either because you're obligated to sell the stock due to the covered call. And so what this does is this creates a way with which you can have a significant amount of the stock protected and not pay anything for it. Because as soon as that covered call is sold, that premium is yours. Now, always and forever. However, you're obligated to sell the stock at that price. But with the premium, you can purchase the put. This is just a way with which you can shift risk in another format. Now, the same strategies that we talked about on the married put video, such as using the profits from the put to maybe buy more stock or doing nothing, whatever the case may be, a lot of those apply to this covered call and married put together collar strategy as well. You can be both active and passive in a collar, just like you would be in a married put. This is a strategy that you can do when you want to have exposure to a stock, but you don't feel comfortable taking on the risk, and you feel even less comfortable buying the protection. This is kind of a way with which to have stock exposure, but not having all of the risk to it. Now, what we're showing here is just one variation of it. You could make it so that the collar is at the money. You'd have to pay a little bit of a debit for it. So for example, if we wanted to buy the 50 put instead of the 45, we could pay a little bit extra for that. You can also do different time frames. In this example, the time frames are the same, but you can use different time frames as well. It all depends on what you're looking to do. If you enjoyed today's video, please subscribe. That's how we get our content out to more viewers. If you are looking for a financial advisor who uses collars, feel free to reach out to me. You can check out my website, stcharleswealth.com, or you can follow me on Twitter at Mike Tusaw. Thank you and have a wonderful day.
Today is October 30th, 2025. What you are looking at is an option chain of a stock that closed today. 414 days until expiration. What we can do with this collar is similar to what we do with XYZ stock in the previous video. However, the risk reward here, as you're going to see, is much more favorable. We can buy 100 shares of the stock, buy a protective put at the 440 level, and simultaneously sell a 490 covered call for a very similar price, actually a little bit more than what we paid for the protective put. Now, what you'll notice on this is the fact that we actually have protection right at the current price of the stock, meaning there's zero risk to the trade. Yes, you heard that right. There is zero monetary risk to the trade. However, there is upside that is capped, meaning that we will not participate on any upside of the stock past 490. What's exciting about this collar is the fact that you have the ability to own a stock at the 440 level, have $50 of potential upside, and not have any risk to it. By doing that, if you do the math, the annualized potential rate of return is going to be approximately 10% should the stock expire above 490. It's a little bit more than that, but it takes longer than a year. That's how we're getting the 10% annualized. If you would like more information on this strategy, or if you're interested in working with a financial advisor who uses this strategy as part of his very vast array of tools in his toolbox for his clients, feel free to shoot me an email or give me a call. Have a wonderful day.